Welcome back to CMA USA Exam Coach, your study companion. In our last episode, we discussed the first step in the risk management process, which is risk identification. We explored how companies identify potential risks by looking at both internal and external factors and using different techniques such as brainstorming, SWOT analysis, questionnaires, and even technology. Now that we know how to identify risks, the next step in the process is risk assessment. This step is all about evaluating those identified risks, understanding their likelihood, and analyzing their potential impact on the organization. In simple terms, we are moving from just listing risks to actually measuring how serious each risk is. So let's begin our journey into risk assessment.
So in our last session, we covered the first step in the risk management process, which is risk identification. Today, we are moving to the second step, which is called risk assessment. Now, what do we mean by risk assessment? Risk assessment is the process of analyzing and quantifying the risks we have already identified. But we don't just list them. Instead, we look at each risk from two important perspectives. The first perspective is the likelihood of the risk occurring. In other words, how probable is it that this risk will actually happen? Is it very likely, somewhat likely, or very unlikely? For example, in a manufacturing company, the risk of machine breakdown might be considered highly likely if the equipment is old and poorly maintained. On the other hand, the risk of a natural disaster, like a tsunami, may be very unlikely depending on the location of the plant. The second perspective is the potential impact or the relative significance of the risk if it does occur. This means if the event actually happens, how serious would the effect be on the company? For instance, a minor machine breakdown might only delay production for a few hours, so the impact is low. But if a fire destroys the entire warehouse, the impact is extremely high because it can disrupt operations, damage assets, and even cause loss of customers. So, risk assessment is really about combining these two factors, likelihood and impact, to understand which risks deserve more attention. Some risks may be very likely, but have a small impact, while others may be unlikely, but have a massive impact if they occur. This is the foundation of risk assessment, and we will now explore different ways to evaluate risks in more detail. Now, when we talk about risk assessment, we need to understand that it focuses on two kinds of risk that we already covered under types of risks. These are 1. Inherent risk. Inherent risk is the level of risk that exists before we take any action to manage or control it. In simple terms, it's the natural risk associated with a particular activity or process. For example, imagine a bank that gives out loans. The inherent risk here is the possibility that some customers may not repay their loans. This risk exists naturally because lending money always carries the chance of default. Another example is in a factory. Operating heavy machinery has an inherent risk of accidents or injury, even before any safety measures are put in place. So, inherent risk shows us the raw level of exposure that the company faces if there are no controls or safeguards. 2. Residual risk. Residual risk, on the other hand, is the risk that remains after we apply controls or risk management measures. In other words, even after we try to reduce or manage the risk, a certain amount of risk will still remain. Let's go back to the same bank example. The bank may reduce the risk of loan defaults by checking the borrower's credit history, asking for collateral, or setting strict repayment terms. But even after these precautions, there is still a chance that some borrowers may default. That remaining portion is called the residual risk. Similarly, in the factory example, the company may introduce safety training, protective gear, and machine guards to reduce accidents. But even with all these measures, the possibility of an accident is never zero. That remaining risk is the residual risk. So, the key difference is, inherent risk is the risk before any action is taken. Residual risk is the risk that still exists after all the precautions and controls. Both are very important in risk assessment, because management needs to know not just the natural exposure, but also what level of risk will remain even after mitigation efforts. Now that we've discussed inherent and residual risk, let's move a step further and talk about how exposure to risk is actually assessed. Exposure to risk is assessed by looking at two key factors. 1. Loss frequency or probability. This measures how often a loss is likely to occur within a given time period. In other words, it looks at the likelihood of the risk happening. For example, if a company calculates that the loss frequency is 0.25 per year, this means there is a 25% probability that the loss will occur in any given year. Another way to interpret this is that, on average, such a loss might happen once every 4 years. So, loss frequency is about the probability of an event happening over time. 2. Loss severity. Loss severity, on the other hand, measures how serious or costly the loss will be when it occurs. This is not about how often it happens, but rather about the impact when it does. For example, let's say historically, a company has suffered losses due to fire or burglary. After analyzing the records, the company finds that the average cost of such a loss has been around $50,000. That $50,000 becomes the benchmark for estimating the severity of similar future losses. So, to summarize, loss frequency tells us how often an event may happen. Loss severity tells us how much damage it could cause when it does happen. Both of these factors, probability and severity, are crucial in assessing risk exposure because they help the company decide how significant the risk is and how much attention or resources should be devoted to managing it. Now that we've seen how risk exposure is assessed in terms of frequency and severity, the next step is to understand the tools that can be used for risk assessment. These tools fall into two broad categories. 1. Qualitative tools. These are more descriptive in nature. They don't always rely on heavy numbers, but rather focus on judgment, ranking, and mapping risks. The first qualitative tool is risk mapping. Here, risks are plotted on a map, usually based on their probability and impact. This gives a visual picture of which risks are minor, which are moderate, and which are critical. The second one is risk ranking. This involves prioritizing risks from most important to least important, so management can focus on the areas that need the most attention. 2. Quantitative tools. Unlike qualitative tools, these use numbers and calculations to measure and compare risks. Some of the important quantitative tools are value at risk, which estimates the potential loss in value of an investment or portfolio over a given time period at a certain confidence level. Cash flow at risk, which measures how much cash flow could be at risk due to uncertainties. Earnings at risk, which looks at the potential variability in a company's earnings. Earnings distribution, which shows the range and likelihood of different possible earnings outcomes. Earnings per share, which evaluates the effect of risks on shareholder earnings. And finally, benchmarking, where a company compares its risk measures against industry standards or competitors to see how it is performing. So in simple terms, qualitative tools help us describe and prioritize risks, while quantitative tools help us measure risks with numbers and financial impact. Risk mapping explanation. Risk mapping is a qualitative risk management tool. It visually represents risks on a chart, usually with two dimensions, x-axis, frequency or probability of the risk occurring. Y-axis, monetary impact or severity of the risk. The purpose is to show which risks are minor, moderate, or critical, so that management can prioritize them. Looking at this risk map, the green zone shows low probability and low impact risks. For example, risk A and risk C. These risks are less important and usually can be accepted or monitored with minimal effort. The yellow zone shows medium-level risks. For example, risk D, risk E, and risk F. These require management attention and preventive measures. The red zone shows high probability and high impact risks. For example, risk G and risk H. These are critical risks that require immediate and strong action, such as controls, mitigation, or even insurance. Another point is prioritization. Risk H is in the top right corner. Very high probability and very high impact, so this is the most dangerous risk. Risk A is in the bottom left corner. Very low probability and very low impact, so this is the least significant risk. By placing risks on this grid, management can easily see which risks need urgent attention, which risks can be tolerated, how resources should be allocated for risk management. In simple terms, risk mapping helps organizations see the big picture of risks in one chart, making it easy to communicate and prioritize. Next, we are looking at a risk ranking chart, which is a qualitative risk assessment tool. This type of chart is often called a risk matrix. On the left-hand side, we see the scale for likelihood, ranging from rare at the bottom to imminent at the top. Rare means the chance of occurrence is very low. Imminent means the risk is almost certain to happen very soon. At the bottom, we see the scale for impact, ranging from very low on the left to critical on the right. Very low impact means even if the event happens, the loss or damage is minimal. Critical impact means the loss or damage is very severe, potentially threatening the entire business. Now, when we combine likelihood and impact, the chart assigns a risk ranking. In the green zone, we see very low or low risk. These are risks with either low likelihood or low impact. Managers usually just monitor them. In the yellow zone, we see moderate risk. These risks need attention, and management may apply some controls. In the orange and red zones, we see high and critical risk. These are the most dangerous. They either happen frequently with high impact or are imminent with severe consequences. These must be addressed immediately with strong risk management strategies. For example, if a risk is frequent in likelihood and has a high impact, the chart shows it as high risk in orange, but if the same risk has a critical impact, then it moves into the critical red zone, which is the most serious. So, the purpose of this tool is to help managers visually identify which risks are minor, which need monitoring, and which require urgent action. Now let's move to our first quantitative assessment tool, which is value at risk, also called VAR. Value at risk is basically a statistical measure that tells us the maximum expected loss that a company, portfolio, or even a single investment might face, within a certain level of confidence and over a specific time period. Think of it like this. Management wants to know, what is the worst-case loss I could expect under normal market conditions in the next day, week, or month? That's exactly what VAR tries to answer. For example, suppose a bank calculates its one-day value at risk at $5 million with 95% confidence. This means that under normal market conditions, there is only a 5% chance that the bank will lose more than $5 million in one day. On the other hand, there is a 95% probability that the loss will be less than or equal to $5 million. This makes VAR extremely useful for banks, investment firms, and regulators because it gives a single number to measure and communicate risk exposure. Key points to note about VAR. It quantifies potential loss in monetary terms. It is always tied to a confidence level, like 95% or 99%. It is tied to a time horizon, like 1 day, 10 days, or even 1 month. So in short, VAR tells us how bad losses could get, with a certain probability, over a certain time. Now that we understand what value at risk means, let's go one step deeper and see how VAR is actually calculated. There are 3 main methods that organizations use. 1. Historical method. This method is the simplest to understand. It looks at the actual past data of returns or losses and assumes that the future will behave in a similar way to the past. For example, if we analyze the last 1,000 trading days of a stock portfolio, we arrange all the daily returns from worst to best. Then, depending on the confidence level, we can directly pick out the loss level that represents the value at risk. This method gives a vision of the future using history, but the limitation is that markets sometimes behave in ways we have never seen before. 2. Variance-covariance method. This approach is more mathematical. Instead of relying only on past data patterns, it assumes that returns are normally distributed, and then uses the mean and standard deviation of those returns to estimate risk. That's why this method is also called the parametric method. The formula uses the average return, standard deviation, and a z-score depending on the chosen confidence level, like 95% or 99%. This method is quick and widely used, but the problem is, if returns are not normally distributed, it may not give accurate results. 3. Monte Carlo simulation method. This one is more advanced and relies heavily on computer models. Here, thousands of possible scenarios are simulated for how market prices or returns might behave in the future. The model then calculates potential losses for each scenario, and from that distribution, it estimates the value at risk. This method is powerful because it can handle complex portfolios and unusual market conditions. But it requires strong computational power and accurate assumptions in the model. So to summarize, the historical method looks backward at past data. The variance-covariance method relies on standard deviation and assumes normal distribution. The Monte Carlo method simulates many possible futures with the help of software. Let us take an example to understand value at risk more clearly. Suppose the value at risk on an asset is estimated at $100 million at a 1-week time horizon, with a 95% confidence level. What does this really mean? It means that, based on the statistical model used, there is only a 5% probability that the asset will lose more than $100 million in value in any given week. Or in other words, in 95% of the cases, the losses are expected to be within that $100 million limit. Now, keep in mind, this does not mean the maximum loss is capped at $100 million. The actual loss could be higher, but the probability of such a higher loss is only 5%. So, value at risk gives management and investors a way to set expectations and prepare for the likely range of losses within a specific confidence level and time period. Next, we have cash flow at risk, often called CFAR, works just like value at risk, but instead of looking at the market value of an asset or portfolio, it focuses on the company's cash inflows and outflows. It measures the probability that cash flows will fall below a certain amount within a defined time frame. In practice, management tests the expected cash flows against different risk factors, such as changes in exchange rates, commodity prices, or market demand, to see how sensitive the cash flows are and to prepare in advance for possible shortfalls. Earnings at Risk, or EAR, is a risk assessment tool that focuses specifically on how sensitive a company's net income is to interest rate changes. Since interest expenses or income can vary significantly when rates go up or down, EAR helps investors and managers estimate how much the bottom line could change in a given period. This makes it an important measure for financial institutions and businesses with high debt exposure, as it shows the potential effect of interest rate volatility on profitability and overall financial position. Earnings distribution is a statistical way of showing the possible outcomes of a company's earnings. Instead of providing one single expected figure, it presents a probability distribution, which shows different potential levels of return and how likely each one is. For example, management can see whether earnings are more likely to be stable or whether there is a wide range of possible outcomes, which helps in evaluating both opportunities and risks. Earnings per share distribution applies the same idea of probability distribution, but focuses on earnings per share, or EPS. Since EPS is an important figure for shareholders, this distribution shows the possible values of EPS under different scenarios and the probability of each outcome. This helps investors understand not only the expected EPS, but also the uncertainty and risk around it, which is useful for valuation and decision-making. Benchmarking in risk management is the process of comparing a company's risk exposure and performance against other similar companies or industry standards. It helps to identify whether the company is taking on more risk than peers, whether its financial position is stronger or weaker, and how effectively it is managing those risks. By learning from competitors and industry leaders, Benchmarking provides insights into best practices and allows management to set realistic goals for risk management.
Thank you for watching this episode. In today's session, we completed the second step in the risk management process, risk assessment. In the next episode, we will move forward to the third step in the process, that is risk prioritization. Until then, make sure to practice questions and take time to understand each concept we explained in detail. Keep learning, stay consistent, and I'll see you in the next episode. Bye for now.